And welcome back, Realty Pros, to part two of the Home Buyers Expo. So today we have a tag team that's going to be presenting for us today, and that would be our owner, Mr. Porter, our agent, Curtis Price, and our lender, Michael Cooper. So you gentlemen are free to go ahead and take it away. Thank you so much for being available to us.
Oh, no problem. No problem. So, well, most of y'all know me. I'm Mike Cooper. I'll start with a quick intro. Been in the business 24 years. Seemed like just yesterday I met the Porters. And next thing you know, 10 to 15 years later, we're still doing business together. With that being said, if you've been in the business 24 years, you've seen a lot of come, a lot of go, a lot of highs, a lot of lows. And so what my job today, and, being on the panel, which, I want to thank you all for inviting me and allowing me to be a part of this. But my job today is just to talk about some of the things that will help all of you and address any questions that you may have to help you succeed and get through the next hurdle. The fun thing about this is that, like I said, you've seen the highs, you've seen a lot of lows. And one of the best things I know for a fact, without a shadow of a doubt, and it's real simple. Some of you might laugh, some of you have heard it when you were younger, but it's the easy saying, quitters never win. And that's the thing, in this pattern of what we're going to go through in this business and the highs and the lows, just hanging in there, stick to it, go with the flow, make the adjustments, learn, redirect, readapt. And that's usually the pattern, the secret, just to get back on the horse and wipe the dust off and do what you have to do. So with that being the case, I already have a couple of questions, and I'm going to address these first two. And I'm not sure where they came from, but I really love the first one because that's one of my favorite ones. And I'm going to tell you why it's a favorite of mine. It's because we're doing a class on this right now. And one of the questions that came up is about the buyer's or the seller's concession. Can the seller's concession be used to buy down the interest rate or to lower the payment? Yes, it can. Yes, it can. Yes, it can. But there's more to it when we talk about buy down. So I'm going to give it to you from the mortgage perspective. So first of all, you have to understand when you use the word buy down, you can't use it loosely. There's a regular buy down and then there's a temporary buy down. And a lot of times when people come to me, they don't know what they're talking about. When we know first-time home buyers, they probably read or heard something, and then they want to come in and ask for a temporary buy down. Well, we have to make sure we understand or they understand what the difference is right off the jump. A temporary buy down is just what it is. It's temporary. So that means that they have the opportunity to lower their rate. And I'm gonna use this particular rate for now. This is not true. This is just for, just to get through it. But if you had a 6.125% interest rate and they wanted to buy it down, let's say 6%, make it easy. 6% interest rate, and they wanted to buy it down to 5.5%. It's a nice buy down. But the thing is that if it's a temporary buy down, it's only set for that payment for 2 years. After those first 2 years, it goes back to the regular rate. And so, you're going to find in a lot of cases, your client might be upset 2 years later when they find out that their payment has increased. And of course, as a first-time home buyer, you're so excited, or they're so excited that they forgot all about the temporary buy down. So the first thing is we got to make sure we understand there's a difference between the temporary buy down and a regular buy down. And now knowing that, the regular buy down, how does that help you? How does that help the client? Does it work? In some cases it does, in some cases it doesn't. So one of the things, I pulled out some of my old school notes that I'm using for our class that's coming up in our training. And one of the things that I always tell everyone when they ask about buy downs is that it's actually pulling money away from your closing costs. That's what it is. It's pulling money away from the closing costs. So if I'm gonna use the example of 6% interest rate, I wrote it down. So if you have a client that has a 6% interest rate today, and that monthly payment is roughly about $23.45, Now, that might not be accurate because I'm just doing this on pen right now in an old calculator, but about $23.45 per month. And that's for a $400,000 purchase. And they wanted to buy it down to 5.5%. If they did that and they bought it down to 5.5%, that would take their payment down to $2,200 per month. Now, what is that savings? That saves you what, about a little over $1,000 per month, and they're absolutely happy with that saving. But if you bought this rate down and you came to me and you said you wanted that rate at 5.5% and you wanted the savings or the monthly payment of $2,200 per month or $2,222, that would cost you $4,688. Now, what does that mean? That's the cost that you're going to have to increase as a discount point towards your closing costs. The only advantage, or one of the best advantages, is that you do get to write it off. It is a write-off. It is tax deductible. So that's the beauty of it. It is a true origination discount point. Keep in mind, all origination points and all discount points can be written off. So that's a good thing. But if you're going to pay $46.88 and you're going to buy this rate down, and the other thing is that, you're trying to figure out where's this cash going to come from. And then you have a buyer or a seller that's willing to give money towards the closing costs, then that's going to eat away some of that money. So I gave you the mortgage version. Now let me break it down for the agents. I'll give you a different version. Basically, all it is we're going to take a little bit from the seller concession to be able to cover the closing costs and increase it. So how does that work? Your closing cost is $10,000 right now. All these numbers I'm just making up just for facts. So your closing cost is $10,000. You're buying a house, new buyers excited. $10,000 is where we stand. The seller's giving them $12,000 towards seller concession. So right now, the buyer has $2,000 to work with. In this case, this would be an advantage for them because they can use that. They don't even have to use the whole amount. They can say, okay, hey, Mike, Mr. Mortgage Guy, help me out. I want to get a lower rate. I got $2,000 extra to work with. And then I might come to them and say, well, if you really want the 5.5%, it's going to cost you $4,600. You have two. Are you willing to pull up the extra $2,600? Or would you like to see if I can negotiate something else and work another trade? And maybe we don't have to go as high as 5.5. That way you don't have to come out of your own pocket. I love doing it that way and negotiating the buy down. The reason why that's so important is because sometimes people really don't want to use their own money. A lot of times, if you use your own money, it takes a while to catch up for that. So here's another example. You take this person, the same person, at $23.45 per month, and then we got a payment of $2,200 per month. The difference that they saving is really about $123 per month, and that's fine. But if they bought this rate down and they use their own money of $46.88, it would take them 4 years to recoup their money. That's one of the words that we use all the time when it comes to buy down on our side. That's our language. The mortgage side is the recoup. What is the recoup period? When will he recoup or she will recoup her money? If it takes 4 years and then they refinance before that, then it wasn't worth it at all. So we always have to find out what's the most important thing. Do they want to save money or do they want to save on the closing costs? It just depends on the client, but hopefully that will address, or that's some information that you can use addressing the first question about buying down. Now, before I go into the next one, I want to see anybody have any questions about that one.
Hey, Mike, I have a quick question.
Okay.
With the seller concession, I know during, the height of COVID and everything, buyers really weren't able to get the sellers weren't giving anything up. Have you noticed a shift kind of in the market where, new buyers out there are able to get the sellers to come out 1% or 2% or maybe even, 3%?
I've been seeing it more and more. It's almost now it's beginning to shift. And so we know that we're in that phase. we're all caught up in the shift. I mean, we saw it, we've seen it before. I've seen it before. The inflation, some of the values have tapered out. Some of them have slowed down. I've seen situations, I've heard of situations where some folks had their house on the market and they pulled it off and they're just gonna put it out as a rental. And so because of the shift, now it's making it harder for some of these folks to sell it. I've seen more houses on the market a little bit longer than what they usually are. And so in that case, they are offering more seller concessions. And I've seen it anywhere from 1% to 3%. I did see one at 4% about a month ago, and it just blew me away. 4% seller concessions. So we are well on our way to seeing 6% seller concessions again.
Wow.
For FHA loans. You're going to see it because people that want to sell a home, they want to get out of this. And you know, for whatever reason, if they want to purchase a new home or they just want to move somewhere else or whatever the case may be, you're going to start seeing more and more seller concession. And that's the way we're going right now. I tell you what, the funny thing about that, because we're seeing more seller concessions now, seller concessions, I'm sorry. It's funny because now I'm beginning to go back, and this is a tip for all of y'all that's hungry and aggressive with going back to getting business. I had to go back and get my old pipeline and revisit some old files because now we're at a place where with a first-time home buyer program and aggressive seller help, and if we can still close this in 21 days, that's an attractive offer. So this might be a great time for some of y'all to go back and grab some of those old clients because that's what I'm doing right now. I'm going at it like a telemarketer. I'm beginning to call old people and say, hey, remember, yeah, Shay Porter and I, we worked with you about a year ago. Hey, we got some new programs. This is what we're working at. The first thing they're going to say, though, is that I hear the rates are bad. You know what? The rates are higher than what they were, but they're not bad. And that's the way I always handle that. Yes, they are high. And to be honest, if you're waiting for them to go down, you're gonna be waiting a long time because we don't know. None of us can control that. So we don't know how that's gonna work out. But I am going back to revisit all of these and I'm beginning to talk to them and spread the word that, hey, this is still a great time to buy because now you're getting more money and you're getting opportunities where sellers are giving you concessions, and it's a good thing to take advantage of. I hope I addressed that for you, Curtis.
Hey, Mike, thank you for that. And I know that, you know, we have another question. Before we jump into that, though, I just wanted to just draw everybody's attention to the fact that, you know, what we're really talking about and what we're preparing you all for is if you're going to participate or hold your own Homebuyer Expo, we want to make sure that you have the ammunition that you need in order to address some of the concerns that potential home buyers might have. And so, Mike, if you just draw your attention to the slide that we have in front of you, it says first time buyer and no down payment. You know, that's the draw. We used to use that as the advertisement, the draw to get people in. Are there any programs available right now, or do you see any coming down the pipe that we would be able to market? Because we always need to have something that draws the potential buyers into the Home Buyers Expo. So what are some of the buzz lines or some of the, you know, exciting things that you might be able to do that's coming down the pipe? Or if these programs are still around, you can share that with the team.
Well, let me give you both sides of that coin, okay? The first thing that you got to keep in mind is that every lender is going to have a program. Everyone has a catchphrase right now, but you better be aware. Be aware. It's a catchphrase. Why not? I mean, that's what they do with commercials. We try to draw your attention. We try to catch you, grab you. And the funny thing is I'm getting more business for those deals that fell apart like that too. Because the thing is that it wasn't everything that's written, you know, everything that what you see is not what you get, basically. So there are a lot of lenders, a lot of mortgage companies that's trying to find ways to do stuff, but read the fine line. But the Mortgage Maryland program, everyone knows that one. They've actually added some new guidelines and some revisions to their grant program, which I love. They have a 5% grant. Hear me out, 5% grant. I love it. 5% grant. I had to say it 3 times because that means if you're purchasing your buyer, if they eligible and they purchasing a home for what, $300,000, they're going to get $15,000 towards their down payment and closing costs. Now, why is that one so important and why is that one exciting to me? Because if you're doing an FHA loan, well, all of you know that the minimum requirement or the minimum required down payment is 3.5%. So that's a great time where you can give them a 5% grant down payment. They can use 3.5%, cover their down payment. And then the other 1.5%, they can use that towards their closing costs. That's awesome. Especially in this day and age that now we're beginning to get back to a place where we can ask for 1 or 2% seller concession. So when MMP or Maryland Mortgage Program launched that about a couple of months ago, it blew me away, 5%, and we can still close those suckers within 25 days. So I love it. That's a good selling tool, a good tip, and I love that program. Here's the best thing about that one. The rates are not that high. You have to keep in mind when it comes to programs, they kind of jack you with the interest rates and they jack them up a little bit because, you know, not everything is free. So some kind of way they have to make their money some kind of way. But with that particular program, at least Tuesday was at 6.5%, and that was exciting. So, you know, that's a good thing. Then you have to keep in mind, here's the way you work this one. And I'm gonna finish on this shade and I'll give you the other one. But here's the way you work it. And this is the way I sell it. Hey, go ahead and take advantage of this, Miss Darlene. Go ahead and take it, get your 5%, get your down payment money, get your house. And then after that, after you make 6 payments, you are free from that grant. So if you say, okay, wait a minute, this 6.5% interest rate, but the regular rates are 5.8, and I heard they're going down. Well, if you make on-time payments after you get this program, you get your house, you had your house, the housewarming party and everything, you made 6 payments, you can actually refinance that house out of that program, maybe take advantage of a lower rate if it's available, and there's no obligation, no commitment. So you just got $15,000, you made 7 payments and you're free. All right, so that's a good tidbit. That's my favorite from the Maryland Mortgage Program. When they came out with that, I called my account rep and just went off and said, hey, this is awesome. I'm loving this. The other thing is we do this program, Chenoa. Now, some of you have heard of Chenoa, and Chenoa is kind of, it can be bitter or sweet sometimes, okay? But right now it's sweet, because when I first came over here with Certainty, I was, preaching Chenoa, and then I was like, ooh, wait a minute. So I had to back up for a second. They made revisions. They have a 5% grant too. Now you have to make a small payment. That's the only difference. You have a monthly payment about $100 or $120 per month until you get out of it. But here's the advantage with this one, where the difference between this and Maryland Mortgage Program. Maryland Mortgage Program have income limitation. So they will cap you out at a certain amount. Now, I don't know what it is off the 5%, but it's usually somewhere about $145,000 or $150,000 combined. So if you make over that, then chances are you ineligible for the program. But for the Chenoa program, no income limitations, no cap. So if you're making $225,000 per year and you want to take advantage of this, because programs for first-time home buyers and no down payment programs were really guided towards people that needed the help, not for somebody that's what we call ballers. So in other words, if you're making over $200,000, you can still take advantage of this program. Ooh, that's good stuff. Now, here's the next one. To add to this, you can combine Chenoa and Maryland Mortgage Program in some cases. Ooh, this one I need to be in person. This is when you can combine both of them. So you can actually get away with putting absolutely nothing down. Now, I promise you, PG County has another new program that they launched. I'm not preaching it yet because I want to wait till I take the class. But they have another one that they're going to launch, and I heard it's really nice. I don't know if you've been keeping up with the news in DC, HPAP have changed their guidelines. So they're giving out more and more money. So for the DC homes, and I haven't heard anything about DC open doors. They still at 3.5%. But everyone knows, and it's so funny when we see these trends, we know that the market has shifted. The market has changed because it's the same thing. Rates go up, we start seeing seller concessions, and we start seeing more programs because they still want to make sure that we can find a way to still get people in the homes. And you're going to see more and more first-time buyer and no down payment programs as we move on.
I think
Any other-
Darlene had a question, Mike.
Oh, okay.
Darlene, did you have a question? Your hand, I see your hand is raised. You're muted. Unmute yourself, Darlene.
There we
Okay.
go.
My question was back when he was talking about the buy down.
Okay.
And it was, can you, and you may have already explained it because I was a little bit late. That was my question. How it would be advantageous for a seller. Because I know I read an article about buy down, and it was about a seller getting what they wanted out of their house, but at the same time, giving the buyer, buying down the interest rate for the buyer so that they can actually get what it was they were trying to get from their house. I don't know. I'm paraphrasing it because it was a long article, but that's basically what it talked about.
I'm picking it
Like,
up. I'm picking
The
up.
buyer had to be able to afford it, of course, but it was, I'll have to send you the article, but that's what I wanted to know.
Okay. Two things. First of all, I'll explain that. I know exactly what you're talking about, and please send me that article because I would love to read that. Secondly, basically in that particular situation, they probably did it just to help the buyer to qualify. Maybe the debt to income ratio was too high, because that's still one of the things that we do have to worry about because rates have gone up. So keep in mind too, let me throw in this plug, that rates do move, they do shift. Rates can change, and a lot of times people forget this because if we give you a pre-qualification letter today at a certain rate, it can change by the time to close a business. So if that rate changed, that rate shifted, and that seller really wanted this buyer to have that house, then they probably did give them a seller concession. And that basically means that they gave them money towards the closing costs, but they could use it as the buy down. So if they use it as a buy down, I mean, you can use it either way, Darlene. So you can use it towards the closing costs, which I did say that earlier. You can use it either way. Use it towards your closing costs or use it towards buying down your rate. If you use it towards buying down the rate, then that will lower the monthly payment. And then the other thing I said is make sure when we do this, you don't want to have a temporary buy down. If you do a temporary buy down, it's only for 2 years. But if you do a regular buy down, then it's for the life of the loan, which is over a 30-year period. Now, what is another advantage of a buy down too, since we revisit this, is that the life of the loan makes a difference on the buy down. If you do a buy down and you pay that upfront money and you're going to keep this loan at least over 10 years, then it's a benefit to you. But if you're going to keep a loan for less than 4 or 5 years, then it's no point in buying down the rate. But in that particular case, Darlene, they just did that to help them up. That was creative financing. I can relate to that because, you know, sometimes we got to think outside the box to make a deal work. And that's what they did. Anyone else?
Yeah, Mike, I see D'Amica had her hand raised. D'Amica, did you have a question? All right.
Okay.
Out of D'Amica, if you can unmute yourself. If you have a question, just chime in, D'Amica, when you get a chance. So those are very good, a lot of good information to know, Mike. And I know we had another question, but I'm going to keep jumping in there because I did get one from a buyer in reference to, you know, we've heard a lot about some appraisal inconsistencies. Let's say it like that. Okay. When it comes to maybe some of the home buyers in the DMV, you know, have you heard, or is there anything that your office or the mortgage side is doing to address, or anything that we need to alert buyers or they should know in reference to appraisals?
Well, I tell you what, we can't control the inconsistency of the appraisers because there's so many of them out there. But what we're doing here, we just had one, I won't say his name. I know this sounds like a sales story, but this is the truth. He came in surprisingly really low for a place in Baltimore. This guy he's followed me in every company, and he's been the same every time. And so we had a meeting and we talked about the pattern of this particular person. And the only way you can handle this with the inconsistencies, I hate to say this, but you as the agent, if you're dealing with a client and you're moving forward and you have a buyer or a listing, I would highly recommend you run comps in your neighborhood too. Be proactive with it just in case. We got to do our homework just to make sure, because that's what I did in this particular case. I did it. I ran the comps, I got them and submitted them, challenged them, and won the battle. The thing is now what we're doing here, if you get like 3 complaints or 3 challenges, then that appraiser is kicked off the list. And so that's the best way to deal with that, because they don't want this. So this is his first warning, but this is his first warning since I've been here, certainty. I asked them, could they combine all my warnings with him? But they wouldn't allow me to do it. But the thing is that this guy is known in the DMV. I won't say his name. Some of y'all may have heard of him, but he is the worst with just lowballing and very inconsistent with that. But I highly recommend do your homework, run your comps on the buyer side or the listing side, and make sure you have a good idea what you're getting into, just in case that appraisal does come back. And there's nothing wrong, because here's another important bit. People don't like to contest appraisals. I don't see nothing wrong with that. But make sure we're just not just throwing it out there based on information last fall, okay? I mean, you know, right now the market has slowed down a little bit, so you got to be in tune with what's going on with the market, and make sure you realize, you know, when you're pulling your comps, pull comps within the mile. That's another thing, because sometimes people do provide contingencies or information to contest an appraisal, but if they like over 5 miles away, that's not a strong selling point. So you want to keep that in mind. I see someone have their hand up. Is it Cheryl?
Hi, yep, it's me.
Hi,
I apologize. Hi, how are you? I
All right.
apologize for earlier. I was having issues trying to get it off of mute, or anyway. So my question is, do you have any programs or anything to help buyers that have student debt, student loans?
There's one with Maryland Mortgage Program, but you have to have a 720 credit score now, and the debt can't go over $50,000. You can't have any more than $50,000 worth of student loan debt. Now, it used to be 680 and 35,000, but they changed it. So they increased it a little bit more, but that's the only one that I know of that will help you with student loan debt. The other thing that we do, I mean, we just try to, you know, last year, FHA did revise their guidelines, VA, FHA, and Freddie Mac did, which was really good. So we used to have to count 1% of your student loan debt against you, which definitely hurt a potential buyer in that case with their debt to income ratio, but now it's 0.5%. So they did take that back down. So if you have a client and they're doing conventional loan and you're working with a loan officer, tell them to go with Freddie Mac. You go to Freddie Mac, you can do 0.5%, and that's your best selling tool that I can give you on that. If they qualify for the Maryland Mortgage Program, it's an excellent program. If they owe no more than $50,000 worth of student loan debt and they have the 720 credit score. And that's all I can give you as far as the student loan debt. And then, you know, they just have to keep paying and working on it. Well, there is one other thing. They could set up a payment plan with the student loan company. My apologies, I forgot that I did that once before. So if they work out a payment plan, and if they owe like, let's just say $20,000 worth of student loan debt, which would normally be $2,000 per month, but the new payment plan under FHA is $1,000. Which is 0.5%. That's a good thing. But if they work out their own payment plan and they get on a payment plan with the student loan company, they might get a payment as low as like $300 or $400 per month, and they can do that. And if they show that they have that payment plan for like 30 years or something, then that will help them to lower their monthly payment, and that will help them to get qualified for a loan.
Excellent, thank you.
You're welcome.
I think I saw a hand
Mike.
raised for Angela. Oh, sorry, who's that?
That
Somebody-
was me.
Go ahead, Kerma. How are you?
Doing well. Mike, the quick question I had was going back to buying down the rate. Can you still buy the rate down if you're still using the program? Because I know you said some of the programs, rates could be a little bit higher. So if you're still using the program and the rate is a little higher, can you still buy that rate down and try to give people a little relief as far as their monthly payment?
Very good question. Very great question. You cannot buy it down with Maryland Mortgage Program. You cannot buy it down with DC Open Doors. You can buy down with HPAP and you can buy down with Chenoa. So it just depends on the program. Now, the funny thing about the Chenoa program, it's great right now, but you won't, I mean, any given day, they can come up and change the guidelines, but that's just like anyone, Fannie Mae, Freddie Mac, and FHA. They can change it anytime, but as of right now, you can buy down the rates with Chenoa. You cannot do it with Maryland Mortgage or DC Open Doors.
All right, thank you.
You got it, buddy. Angela?
Yeah.
Hi, Mike. Yeah, I do have a question. I recently put a house on the market and I immediately started getting calls from lenders saying for the area where I have the listing that they offer 100% financing. Is this something common that you've heard of, or can you give any insight on these? I don't know if they're just marketing calls or if this is actually a thing. I haven't spoken to them, but just wanted to inquire.
It could be. So is it a USDA or in a rural area?
It's a rural area, yes.
That's what it is. It's the USDA loan. So USDA loan, let me just throw this tidbit in there. I love that loan. It's hard to get approved sometimes, but it's 100% financing. It's a government loan. It has to be in a rural area, and there's no mortgage insurance. So there's no MI, just like it's a VA loan. It's 100% financing. Still got the best rates because it's government loan and it's government insured, but it just has to be in the rural area. The only catch with a USDA loan, Angela, is that you have to run it through the system, and the automated underwriting system is called GUS. And when you run it through GUS, you have to get an approval. Like with FHA, Fannie Mae, and Freddie Mac, if we don't get an approval right away, we can tweak it and work around it and still submit it. And we can actually do manual underwriting in those cases, okay? But with USDA, you have to get that, lender has to get an approval. The ratios are kind of tough, like your back end can't go over 43%. Whereas regular FHA is 45, they prefer 45, we can go up to 55% back end ratio. So that's a good thing. That means that we can get, and we have more opportunities to do more lending. But with USDA, they are real cutthroat with going over 43%. They will make an exception sometimes. They'll allow you, Gus will give you an approval, but it has to be like a cookie cutter, picture perfect loan. But yes, to answer your question, if it's in a rural area, yes, they can offer 100% financing with USDA. And almost every lender should be able to do that.
Okay, thank you.
Mm-hmm.
So hand from Curtis. Curtis, are you there? And let's see. Go ahead.
Yeah, that's not me. That's D has her hand.
Okay, D, go ahead, D.
Oh, yes, I am. Okay. So I was just thinking about when you were saying, well, yeah, the rates are they're higher, but they're not bad. And I was just thinking about in the 80s when I first, I shouldn't say this, but when I first started looking for homes, interest rates were in the teens.
Yep.
So whenever people tell me, it's high, I'm like, well, it's not high yet.
No, and I don't think we're going to ever see it in the team. Look, I'll help y'all, D. I did an over equity loan when I first got in the business in 98 or 99. The interest rate was 24.99%. And guess what? They took the loan. So the thing is that if you want to buy, we're trying to, renew our mind. We have to do that as lenders and as agents working with buyers. We have to explain to them that, yes, rates are a little bit higher. They are higher, but they're not too high, and we can still afford it. And one of the things I've been doing lately, I've been showing people the comparison because a lot of times it sounds worse than what it is. I told somebody they can do a 6.25% interest rate. They're like, what? I need 5.75. At least give me the 5.75. I show them the difference in the payment. It sounds worse than what it is, but it wasn't even over $100 difference. And so sometimes we just got to do more hand holding, with these agents. And that's the hard part for all of us on either side. We got to do more hand holding. We have to explain to them that, hey, look, that $100 difference you're griping about, you spend more than that per month on lunch. I mean, seriously, I got a coworker, they spend $20 per day for lunch.
How
That's
about
$100 a week. So I'm just saying, we're talking about $100 per month on one of the best investments you could ever get. Rent is going sky high now. We all know that you'd rather be owners than renters. There's so many benefits from it, the write-offs and everything, and the ownership, tax deductible. And we're talking about $100 difference. So, we have to do more handhold in this day and age. It's going to take more time. That's the hardest thing about this new wave. And it's been going on for years, that we have to spend more and more time. I've been guilty because I've been trying to be in and out sometimes. Those days are all gone. You can't do it. You can't give a microwave service. I have to be, more attentive. We got to be on top of our game to be able to explain that to them so that they'll know what's going on. So, I think that they'll be fine, but we just gotta, just continue to talk to them and teach them. And like you said, back in the 80s, you were back at 13%. Good Lord. So, I get it.
So Mike, guys, let me say this. I want to refocus. We're talking about the home buyers, experience, Home Buyers Expo. When you're talking to home buyers this month, we're focusing in on home buyers. And Mike will tell you readily, whenever he and I, he's doing a deal for me, if he runs into trouble, first thing I tell him is what, Mike?
Fix it.
I don't care about Linda's problems. I said,
fix it.
I said, I did my job. You gave me the pre-approval. I found him a house. Things start to go sideways. I'm like, hey man, don't call me with your problems. I don't call you with mine, Now, and I say that facetiously, but at the same time, it's, me saying, it's my way of saying, you have an expertise that I don't have. My expertise is getting the people to Mike. The most important thing I can say to you is that if you get a lead, you get a person that even says they want to buy a house, I interrupt them. I say, hey, let me send your information over to my lender, because he's the first step. And I want people to, I send Mike everybody. I don't try to, well, I'm going to wait 6 months. That's fine. Let's let Mike look at your situation now and see if we have 6 months worth of work to do, because by the time you're ready, then we're going to be scrambling. Or they'll come up with an excuse, because buyers inevitably, or, it's a psychology to this side of the business. You're working with people, and what you're working with, and you guys have heard me say this even last week, you're working with their FUDs, FUD, fears, uncertainties, and doubts. And the way you overcome those FUDs is with FABs, the features, advantages, and benefits of home ownership and mortgages. Mortgages versus rentals, homeowning versus being a tenant. So you want to make sure that you're selling at all times, and to always do what we like to say, ABC, always be closing. That's my favorite one. So even when Mike calls me, I'm closing Mike. I'm like, I want to hear Mike, get that deal done. I got another person I'm working with. Do you want to go show houses while I solve your problem? He say, no. I say, okay. Well, I'm going to go show the houses. I'm going to get the people to write the contracts. I'm going to call the agent. And then when I get them ratified, don't call me again until we're ready to close. That's what, that's our deal. And I want you guys to know that he's confident. I'm confident. He's competent, and I'm confident in his abilities to figure out things. And Mike figures things out, and we get the closing. That being said, there's some things that we know that we have to condition in our buyers for, and this is why the Home Buyers Expo is just an expose or a bigger way of doing the home buyers consultation, because we're educating buyers into what they need to do. One of the things that Mike, you've done Home Buyers Expos for us many a time, and Mike gets a kick out of what we call the 10 Commandments. those 10 commandments are they're a good way to, kind of groom your buyers is in terms of once we get you ratified, you have to follow the 10 commandments. So Mike is Moses. I like your beard. That's kind of helped with my sales pitch and everything. And you can put whoever's doing the slides, you can put all of the 10 commandments up because I'm just going to go through a few of them. But you want to make sure that your buyer knows what happens once you get them ratified. And once they get to the stage where Mike Cooper or the lender, whomever you have them working with, he's going to have to get this through what I call the goalie. I call her the undertaker, and that's the underwriter. Her job is to protect the bank's money. Mike's job is to give it away. So if you want Mike to help you and help your buyer, you have to help Mike by following the 10 commandments. I don't see all the 10 commandments on the screen, so somebody can keep clicking and they'll all come up. Thank you. And so Mike, you know these 10 commandments: don't change your jobs, become self-employed, don't go out and buy a car, truck, or van, or you might be living in it. Thou shalt not charge your charge cards excessively, let your accounts fall behind. Don't spend money that you set aside for closing. We've been through that a million times. And that's the only one that I've seen trip Mike Cooper up in all these years. He can't do anything once they spend the money.
Can't help it.
Do not omit debts and liabilities from your loan. That's another one that has almost ended a lot of deals. And I remember Mike Cooper had to be, he's just smart. He took the young lady off the loan and put the young lady's fiance and father on the loan. So they bought her a house and she's not on the loan. So I hope the father and the boyfriend still get along. Otherwise they might be calling me, and that's fine. Don't go buy your furniture. Don't originate any new inquiries in your credit, and don't spend large cash deposits without checking with who? Mike Cooper. I call Mike Cooper. I say Mike Cooper is like your priest. He's Moses. He's the priest. You go confess to him that I do have some things that might come up from 20 years ago. I was in a car accident. They gave me the money, but the accident was really my fault. And I was supposed to get the money back, and now I owe all this money, but I don't know if the undertaker's going to find that. She's going to find it. And the last thing you want is for Mike Cooper or any lender to be surprised. So you have to groom your buyers in the buyer's consultation. And this, even in the Homebuyers Expos, we talk about these things. Don't surprise the lender. He's trying to help you out, right? And then the last thing is that you never co-sign and don't change banks. And all of these things, people get upset. They're trying to go get things done at the bank. Because Mike Cooper, I'm going to tell you something. When y'all going through the process, they'll ask you for the same things over and over. Yep. And people get frustrated. They get frustrated. The bank get frustrated with them. They want to leave the bank. Don't leave the bank. The underwriter's going to have a problem with. So, Mike, why are these things that are on the 10 Commandments, why are they such so important for us to make sure that the buyer understands, and how does it affect your ability to help the loan get closed? That's what I'm really asking. You can pick any of them or all of them.
I'm gonna tell you all of them, and I'm gonna group them because they're all of them are the foundation. This is the foundation. This is the pattern. This is the blueprint, as Jay-Z will say. So this is the pattern that you need to follow for a successful loan, because the process, as you mentioned, the undertaker, the underwriter, whatever you want to call her, him or her, their job is to protect the banks, to protect the mortgage company, protect the company, protect FHA and Fannie Mae and Freddie Mac. And so we're on two different sides. And the thing is, when these things are in order, this is usually the recipe for a smooth transaction. The problem that we get is when we get surprises. When we get surprises. I think one more, even though we have 10 on there, I'm ready to add a 11th commandment. One of the things I'm beginning to find out more and more is just, about tax returns, when people are holding back their tax returns and having write-offs. This is becoming a big issue as well. But all of these things, when they are in order, Ms. Porter, it's a smooth transaction. Now, we're going to have bumps in the roads regardless, But this make life a lot easier when we know that you're not trying to make these last minute changes. You're not doing anything. Plus, I'm gonna tell you what else it does. It sets a good tone of, and a good rapport and a good relationship between the agent, the lender, and the buyers. Because if they approach us with these things, then that means that the communication is there. We got an open line of communication. We can talk. We're honest. We're upfront with each other. Let's just be upfront and not have any surprises. I feel like, look, I've been doing this, I told y'all, most of y'all, since 24 years. I guarantee you 95% of the time I can get them done. Now, that's a passing grade. I would like to be at 100, but there's still every once in a while you get slipped up, and you can overcome a lot of stuff if you've seen it all these years, but it's still tough, and it's a lot easier when they work with us in this situation. And I see a hand raised by Ms. D.
So you were talking about the tax rate write-off issue, and I was trying to figure out how would that affect our closing?
Well, if you get a surprise and you have taxes, so if you are a W-2 employee, one of the things we do, I ask for tax returns up front. At one time, I got away from it and I slipped. And recently this year, I just started again asking for tax returns, even if you're a W-2 employee. Because if for some reason, let's say you, Ms. D, you come to me and you're doing a loan and you've been in the government for 24 years, okay? We got you, but you got a side business that you've been, you made negative $14,000 because you wrote everything off. It's gonna come up. And so when they do a 4506, then we can do a 4506 W-2, okay? But in some cases, if an underwriter is looking at this and they see something that triggers, they can do this, okay? Regardless of what's on paper, because we submit it as a W-2 transcript, we want to verify. We don't want to look at your tax returns. I don't even want anyone to see it, okay? When I get returns, I'm trying to hide them. But there's something that triggers the file. That's where it comes into play. There could be something on the credit report or the bank statement or anything else that triggers that you have another business. They have to investigate that. That's what people slip up. Because most people come to me and say, well, Mike, I'm W-2. You don't need to know about my business. No, we don't want to know about your business. I don't know. I only know what you're talking about. But if you trigger something, like if they see it on the bank statement and there's a pattern of you receiving money on your bank statements that they have to use, then they have to address that so that they won't get audited or they won't get fined. So they're trained to do this. So that's where it gets tricky. And most people don't know that. So if something triggers it and we say, oh, shoot, God dang it, we got to get tax returns, we over here praying. Because we already know, like, that could be anything. Anything could go wrong. So now I'm beginning to go back into asking for, and it's good that you mentioned that, hey, he's going to ask for tax returns or she's going to ask for tax returns. Make sure you provide everything up front. That way we can see if we got any slip ups, that could take place and that could set this deal off. So we don't want to do that. So anything that opens up a can of worms, the underwriter will address it.
Thanks. That's really good to know.
You're welcome.
Mr. Cooper, I hate to tell you this, but we just ran out of time.
Oh,
But the
man,
great thing is, hey guys, the great thing is that we do Realty Talks every Thursday at the same time, at the same channel. And we're going to have Mr. Cooper come back. I don't think it's next week. I'm gonna let Anissa tell us when Mike Cooper's coming back, and we're gonna continue our discussion on home buyers and the mortgages and all the things that are going on in the industry. But I do want to be respectful. I know you have some questions. I know. But I'm gonna let Miss Anissa close us out, and then if there's anybody who wants to stay on a little while after, if you have a few minutes. To answer any questions, we can certainly do so at this time. So, Ms. Anita, if you're ready, we can take over. And thank you all for joining us for another Realty Talks.
Thank you all.
Thank you again. Thank you, Mr. Cooper. And so Mr. Cooper is going to be back on the 22nd. And he's going to have more time to just give us some more specifics. So we appreciate you making yourself available to us. And again, thank you for the training today. Is there anything else Let me see. We do want to be respectful of everyone's time, so we'll go ahead and we'll end at this time.